On this episode, we're talking stable income and smart risk management with Canada's top asset managers.
Demand is accelerating. Immigration and declining home ownership, affordability, rental demand has surged.
The sticky nature of inflation has left many investors feeling frustrated.
Active management continues to play a pivotal role in this environment.
So we're seeing investors deploy low-volatility ETFs more as stabilizers in their portfolios.
That you could potentially use your entire investment one day.
Let's get you market-proof fast. Happy to have Ray Punn, President of Capital Markets at Lankin Investments, joining us now. Ray's going to give us a little insight into how the economic shift is affecting investors and what they may want to start paying some more attention to. I'm sure you're curious, so let's dive into some macroeconomics for real estate investors. So Ray, how are housing policies, immigration, and local regulations shaping real estate fundamentals in Canada currently?
Since 2014, Canada's population has grown by over 16%, and more than half of that has happened in just the last 3 years alone. So this growth continues to put pressure on housing markets, especially in demand urban and mid-sized cities like a Toronto or like a Vancouver. In response, the federal government as well as provincials are investing heavily to unlock supply. Purpose-built rental housing starts are expected to remain above the 10-year average through at least 2027, and that's supported by targeted policies. And from an investor standpoint, multi-residential and rental housing remains a resilient and scalable opportunity.
What's one economic shift that really stands out to you that you think investors aren't paying enough attention to yet?
So it's not easy to pick just one, but let's hone in on an economic shift that investors can benefit from. And this is a rising economic value of rental housing in portfolio asset allocation. Historically, apartment rentals may have been overlooked in favor of condo development or commercial assets, but have emerged as stable, income-generating, and policy-backed opportunities. The federal government eliminated GST on new rental constructions, the introduction of the CMHC MLI Select program, which offers low-cost, long-term financing for eligible assets. The Housing Accelerator Fund is also fast-tracking approvals across major cities. At the same time, demand is accelerating. Immigration and declining home ownership, affordability, rental demand has surged. So for an investor, this creates a compelling environment where you can achieve stable, long-term cash flows. There's favorable government policy and financing, and finally, inflation protection through various asset management measures.
Okay, so if you could share one economic insight that every investor should understand right now, what would that be?
There's a realignment of risk and return. Fixed income has become a reliable source of income again. Alternative assets already making up 25 to 40% of institutional portfolios. The story of asset allocation and diversification is something that requires evaluation to achieve optimal returns.
Joining us now is Mike Spero, Chief Operating and Financial Officer at CMI Financial Group, one of the fastest growing players in Canada's private mortgage space. Mike's here to break down how CMI's mortgage investment funds are helping Canadians build resilient portfolios with strong returns and lower volatility, all with a set it and collect it approach that's built for today's markets. So Mike, let's talk inflation and how it affects the alternative investment landscape.
The sticky nature of inflation has left many investors feeling frustrated with the real return they are seeing from their bond or fixed income portfolios. This is where alternatives come in. Alternative strategies that are shorter term, floating rate, backed by real assets are proving to provide a cushion for investors for income generation and diversification away from the public markets.
So given the ongoing economic uncertainty that we're all very familiar with, what can investors expect in terms of risk and yield?
There's really been a shift in investor priorities. The traditional 60-40 split between equities and bonds no longer cuts it for many investors. 2022, when both these markets was down, really forced investors to question the long-held belief that bonds always offset equity risk. Income is becoming another bigger priority. This is not just investors chasing yield. This is investors looking for reliable, consistent cash flow that's not tied to the daily up and down of the markets. They are looking for stable income even when markets aren't.
Given these dynamics, are mortgage investment funds a viable option?
CMI provides products that meet the needs of these investors. Think of our funds as the income building blocks of a broader portfolio, designed to deliver steady, reliable performance irrespective of market cycle. Capital preservation is key within our funds. Each mortgage is on a Canadian residential real estate property. This provides the investor with a passive income-generating asset with the additional security of knowing their capital is backed by an inflation-resistant asset. Our funds return between 7 and 11%, depending on which fund the investor is interested in. We believe our funds provide the type of investment investors are looking for today.
Now we've got Jay Rana, head of JP Morgan's advisor business in Canada. JP Morgan has deep roots and built a strong legacy in Canada for over nearly 4 decades, offering world-class financial solutions with a global reach and local expertise. Jay's here to share insights on navigating today's market with JP Morgan's signature blend of innovation and stability. Jay, the Canadian market launched a record number of ETFs in Canada last year. It was truly unbelievable. What's driving that demand in Canada?
Canadian investors are increasingly looking to diversify investment options to manage risk and enhance their returns. So I think ETFs offer a cost-effective way to achieve diversification across various asset classes and sectors and geographies. The ETF market in Canada has seen just significant innovation, with new products catering to investment themes. So this variety attracts a broader range of investors with different investment goals and preferences.
What role does active management play in this environment, especially for the U.S. market?
Active management continues to play a pivotal role in this environment. Ongoing market conditions, including geopolitical tensions, tariffs, and inflation, can lead to shocks in sectors that cannot be adjusted by passive strategies as rapidly. Unlike active management that can continually assess and respond to complex risks and adjust to exposures in real time.
And how does JP Morgan think about management fees, and how does that compare with other ETFs?
Our ETFs are managed by a team of experienced professionals who are dedicated to delivering strong performance and manage risk effectively. This fee reflects the expertise and resources we bring to managing the fund.
Here's a good one for you. There's a national movement to buy Canadian products these days. So why should a Canadian investor look to support ETFs that primarily invest in U.S. equities?
That's a great question. And I think it always comes down to diversification. Diversification in investment portfolios is a strategy used to manage risk and enhance potential returns. By not putting all your eggs in one basket, diversification helps protect your capital from significant losses that can occur if a single investment or sector experiences a downturn.
Next up, a real treat for investors. Patching in from a small boat off the rugged coast of Newfoundland with the storied Long Point Lighthouse gleaming in the background, if you look real close, we have a true pioneer joining us, Stephen Hawkins, CEO of Long Point ETFs. The name Long Point isn't just a brand. It's a deeply personal nod to one of Canada's most beautiful landmarks and to Steve's own family roots in the region. After guiding Horizons ETFs to industry-defining innovation, Steve is back, once again creating waves in the Canadian ETF world. So Steve, what are single stock ETFs, 2 times leveraged ETFs, and how do they fundamentally differ from traditional ETFs?
It's important to know that while the 2 times leveraged ETFs provide the potential for amplified daily returns, the ETFs reset on a daily basis and are built for active Canadian investors who regularly monitor their holdings. The ETFs are not intended as long-term holdings, as you could potentially lose your entire investment one day if the underlying stock experiences a single-day price movement that is greater than 50%.
Okay, so how is the underlying security selected for the single stock ETFs?
Single stock ETFs are a convenient tool giving the active Canadian investor access to popular US mega cap stocks in a Canadian product without currency conversion costs in their account, as well as any leverage or option activity happens within the ETF, making them easy to use for the investor. Of course, interest rate sensitivity, sector sensitivity, company news sensitivity are all correlations that you have to think about in the ETF because the underlying stock is only the one in the ETF.
How might single stock ETFs enable Canadian investors to respond to microeconomic trends and microeconomic events without direct use of margins or options?
We normally think of ETFs as a diversified basket of securities under one ticker. A single stock ETF, or CDR, holds only one stock, typically alters the exposure by adding leverage, hedge, or increasing the yield through options. Of course, the ETF's assets are then concentrated with that one issuer, which means focused opportunity and risk. As the ETF moves with that single company's news or reports, single stock ETFs are not a full portfolio solution, but rather they can be thought of as an individual holding.
Okay. So what are the risks of using single stock ETFs, and why is it important for investors to understand them as they become more popular in Canada?
The underlying securities are US mega cap names, which means they are subject to size and liquidity screening. Think names like Tesla, Apple, Nvidia, MicroStrategies. These are names that an investor might have an informed opinion upon and potentially have views on regarding their future performance. The screens also ensure effective trading of the ETF, as the liquidity of an ETF reflects the liquidity of the underlying stock.
And now, here is Zayla Saunders from BMO Global Asset Management, ready to reveal how smart ETFs, currency hedging, and diversification can help your portfolio ride out any storm. If you want safer, more balanced returns, you won't want to miss this. Why do low volatility strategies tend to offer better downside protection during market turmoil? And how does this impact long-term portfolio growth?
Low volatility strategies in nature are built to aim to reduce exposure to the most volatile stocks. So in turn, this can help cushion portfolios during market downturns or times of volatility. Where at BMO, we use beta as our key metric. So we're focusing on stocks with a lower sensitivity to market swings. We do this because we believe the smoother ride can help investors stay invested through volatility, which we know is critical for compounding returns over time and achieving long-term growth.
So what should investors consider when evaluating different low volatility investment options?
When investors are considering and evaluating different options, they can do a number of different things, but we always point them to diving into the methodology or doing a deep dive into the methodology. So what this means is they can consider what the measure of volatility the solution is using and also what time frame it's being measured in. So for some, they're using standard deviation, but at BMO, we look at a 5-year beta instead, combining the screen with thoughtful portfolio construction and sector constraints to ensure diversification and risk control.
Well, investors will definitely want to know how to deploy low volatility ETFs alongside growth or higher risk assets to balance their portfolios, especially in this day and age.
So we're seeing investors deploy low volatility ETFs more as stabilizers in their portfolios. Investors are often pairing these ETFs with growth or cyclical assets to reduce that overall portfolio volatility. Especially in today's environment, we're seeing low volatility ETFs used more strategically as a core position and then also tactically as a defense position. Ultimately, these ETFs are being used to stay invested while still managing risk.
How does BMO's use of currency hedging and sector caps set its low volatility suite apart from other competitors? And what needs does this address for global investors?
Thank you for noticing that. So we believe that when evaluating low volatility strategies, there are really two key considerations there. The first is sector concentration, and the second is currency exposure. In terms of sector concentration, when we think about sector caps, that's something that can really help ensure diversification by preventing overweights in low volatility sectors like utilities, where currency hedging can reduce the impact of foreign fluctuations on returns. Together, we believe these tools can help investors maintain a more stable risk profile across global regions, especially for those seeking smoother returns in international markets.
Subscribe to get notified when our next episode drops. And until then, happy investing.